If you've been investing long enough, you'll probably agree with me on one thing. The most dangerous phases of the market are not moments of panic, but moments of uncertainty. And that is exactly where we stand today with Bitcoin. Right now, Bitcoin is no longer in a clear downtrend. But it has also not confirmed that an uptrend has returned. We are at an inflection point, a moment where the market has not yet decided who will control the next move. Over more than 2 decades of working with investors in the United States, I learned one critical rule. Periods of power transition are always the most dangerous for retail investors. Because at this stage, smart money is arguing with itself. Even whales, the players with the most data, capital, and structural advantages, are not in agreement. Some are buying. Others are still betting on a worse scenario. And when whales disagree, the market becomes extremely sensitive. A relatively small push can send price moving violently in either direction. To understand why we ended up here, you need to look back at November 2025. That was the phase when whales didn't make money by predicting the future, but by destroying the crowd's expectations. They aggressively shorted Bitcoin. One whale held a short position for 6 months and made $51 million. $9 million of which came from funding fees. Money paid by longs just to maintain their belief that price would go up. Another whale opened a $449 million short position with 40x leverage. Meanwhile, Bitcoin fell from its all-time high of $126,080 down to the $86,000 region. This is a familiar moment in every market cycle. Retail buys the dip, while whales sell the hope. What many people fail to realize is this. Whales don't need Bitcoin to go up to make money. When funding rates stay positive, longs pay shorts every single day. In U.S. financial circles, we call this strategy. Let the crowd pay me to be patient. That's why whales don't rush to flip their positions. They wait until risk is fully priced in, leverage is flushed out, and emotions are completely drained. And then, something unusual happened. On November 27th, a whale accepted a $1.6 million loss just to close a short position, and immediately switched sides. For a whale, a small loss is not failure. It's the cost of buying information. And that was the moment I knew. The market structure had begun to change. After whales accepted losses to switch sides in late November, the biggest question right now is not, will Bitcoin go up or down? It is, who is actually controlling this market? Because if you look deeply into the on-chain data in December, one thing becomes very clear. Whale behavior has changed, but not in a simple, one-directional way. According to Santiment, wallets holding between 10 and 10,000 Bitcoin, the group we call whales, accumulated an additional 47,584 BTC in the first days of December. At current prices, that equals more than $4 billion. But to understand what this means, you need to place it in a broader context. Just weeks earlier, from mid-October to the end of November, this same group of whales sold more than 113,700 BTC, nearly $10 billion worth. In other words, this is not normal buying behavior. This is a very clear strategic reversal. From over 20 years of working in U.S. markets, I can tell you this. Whales never reverse because of emotion. They reverse only when conditions change. And the biggest condition that changed here is leverage. In the first week of December, the crypto market saw nearly $1 billion in liquidations. More than $600 million of that came from long positions. Those who were convinced that price would bounce back soon were wiped out. In finance, there is a very simple but extremely accurate rule. No sustainable bottom is formed while leverage is still alive. Whales understand this better than anyone. They don't buy when the market is full of hope. They buy when hope has been forced to sell. At the same time, Bitcoin did something very important. It held the support zone around $83,000 to $86,000. Price moved lower, but it did not continue to collapse. In market language, that is a signal that selling pressure is starting to run out. But if you think this means all whales are now bullish, then you're misunderstanding the situation. The reality is, not all whales have switched sides. Whale 0x5D2F, who made over $51 million shorting Bitcoin, is still holding a short position. The $449 million short opened earlier in the year is still active. This tells us a very important truth. The market is still in a tug-of-war. This is not a clean reversal. This is a debate among the smartest players in the market. One side believes most of the risk has already been priced in. Current prices are attractive. The other side believes we still haven't seen the final shakeout. And in phases like this, price is the only referee. There are two levels I want you to pay close attention to. The first is $86,000. This is the survival line. As long as Bitcoin holds above this zone, the accumulating whales still have a chance to gain control. If price starts to move higher and breaks above $93,000, that would be a very strong signal that the accumulation phase has succeeded and an uptrend is being confirmed. But if Bitcoin breaks below $86,000, then the $80,000 to $83,000 zone will likely be retested. And at that point, the risk of a false bottom becomes very real. Whales don't argue with words. They argue with price. The most important takeaway I want you to remember from this section is this. Whales don't buy because of good news. They buy when bad news can no longer push price lower. They don't care whether the Fed is guaranteed to cut rates or not. They care about whether risk has been fully absorbed by the market. That is a risk-first, not narrative-first mindset. And that's why, if you're a retail investor, especially one who has lived through multiple cycles, this is not the phase to go all in, but the phase to observe, manage risk, and wait for confirmation. Because in every cycle I've witnessed in U.S. markets, the winners are not the ones who guess the bottom correctly, but the ones who are not eliminated from the game before the real trend truly begins. And this is the point where many retail investors tend to make a mistake. They see whales starting to buy, and immediately conclude, the bottom is in. But in reality, whales never buy based on a single scenario. They buy in layers. They split risk. And most importantly, they accept that they can be wrong in the short term. On Wall Street, we call this positioning, not prediction. Whales are not betting that Bitcoin will definitely go up tomorrow. They are betting that at current prices, the downside risk is lower than the long-term upside. That is a very big difference. If you look back at history, you'll see this pattern repeat again and again. March 2025 is a textbook example. At that time, Bitcoin was in a sharp correction. Market sentiment was extremely negative. Many believed the cycle was over. But on-chain data showed that whales were quietly accumulating. A few months later, Bitcoin rallied from $76,000 to $126,000. What matters here is not the number, but the sequence of behavior. Distribution, decline, liquidation, accumulation, consolidation, trend confirmation. So where are we right now in that sequence? Clearly, we have already passed the distribution and liquidation phases. And we are now entering the accumulation plus consolidation phase. This is the phase where the market does not reward impatience. In my experience working with older U.S. investors, those who lived through the dot-com bubble, the 2008 financial crisis, and the 2020 crash, they tend to share one common trait. They don't try to win every wave. They just try to avoid making big mistakes. And what is the biggest mistake in phases like this? Committing too much capital before the market confirms its direction. Remember this. If Bitcoin truly enters a sustainable uptrend, you will not miss it just because you waited for a bit more confirmation. Major trends always give you time. But if this is only a relief rally within a larger downtrend, capital preservation gives you a second chance. Going all in does not. So instead of asking, is this the bottom? A better question is, what is the market telling me about risk? So far, the signals look like this. Whales are starting to buy, but some are still betting on a worse outcome. Price is holding support, but has not broken out. Leverage has been flushed, but confidence has not fully returned. This is not a clear story. But markets are rarely clear at the most important turning points. And if you are a long-term investor, the wisest move right now is not to act fast, but to understand deeply. Understand that the market does not reward emotion, does not care what you hope for, and does not owe you a good outcome just because you believe. It only rewards those who manage risk better than everyone else. And that is exactly why, at this stage, whales are not talking much. They are quietly positioning and letting the market speak for itself. And this is the moment where I want you to pause for a bit and look at the market from a different angle. Most of the time, markets do not operate on news. They operate on human behavior. News is just the excuse. Emotion is the engine. When Bitcoin rallies hard, people become confident. When Bitcoin drops sharply, people become afraid. And right in between those two states, when hope and fear coexist, the market becomes the hardest to read. That is exactly the state we are in right now. You'll see headlines saying, "Whales are buying, the bull market is about to return." But you'll also see others saying, "This is just a bull trap before the final leg down." Both sides have arguments. And that's what leaves many retail investors confused. In my experience, when the market confuses you, it's often a sign that you shouldn't be making big moves. Because if even whales, the players with the best data, are divided, retail investors have no edge in pretending to be certain. Remember this. Whales don't need to be right immediately. They have large capital. They have time. And they can tolerate short-term volatility. Retail investors cannot. That's why copying whale actions without copying their risk management is one of the most common mistakes I've seen. A whale can buy at $88,000 and stay calm if price drops to $82,000. A retail investor using leverage or committing too much capital cannot. The market doesn't judge right or wrong morally. It only decides who stays in the game and who gets eliminated. At this stage of the cycle, what matters is not whether you have a prediction, but what kind of position you are putting yourself in. Are you in a position where, if the market moves against you for a few weeks, you can still sleep well at night? Or are you in a position where one more sharp drop would be enough to force you to sell in panic? These are very real questions, and they matter more than any technical indicator. One more thing I want you to notice. When the market enters an accumulation and consolidation phase, time becomes the whale's weapon. Price may go nowhere for weeks. That frustrates many people. They start trading more, taking more risk, trying to do something. But in finance, doing nothing is also a decision. And sometimes it's the best one. The major cycles I've witnessed in US markets never begin with excitement. They begin with boredom. And the feeling that nothing is happening. That's when smart money quietly builds positions. So if the current market feels confusing, emotionless, and unattractive, you may actually be in the right phase of the cycle. The question is not, will Bitcoin go up? It is. When the market gives its answer, will I still be there to benefit from it? And that, once again, brings us back to the two most important words in long-term investing: discipline and patience. Before we wrap up, I want you to remember one very important thing. The market does not care what you hope for. It doesn't know the price you bought at. And it does not reward you simply because you believe you are right. The market only reflects human behavior. And history shows that this behavior repeats across every generation of investors. What we are witnessing with Bitcoin right now is not a clear moment. This is not the kind of time when you look at the chart and say, it's all over now. This is a transition phase. On one side are those who made significant money shorting and believe the market still has one more shakeout left. On the other side are those who are beginning to accumulate because they believe most of the risk has already been priced in. When these two forces collide, the market will not give you an immediate answer. It will test you with patience. And this is when many people eliminate themselves from the game. Not because they lack knowledge, but because they lack discipline. In more than 20 years of working with investors in the United States, I have never seen anyone succeed sustainably, just because they correctly called the bottom or the top. But I have seen many people succeed, because they did not lose their position while the market was still unclear. If Bitcoin truly enters a new bull cycle, it will not happen in a single day. It will give you time to participate. And if this is only a rally within a larger trend, preserving your capital and your clarity will give you a second chance, something the market does not always offer. So instead of asking, is this the bottom? Ask yourself a more important question. How well am I prepared for both scenarios? Because in investing, the winners are not the ones who are the most right, but the ones who stay in the game the longest. If you found analyses like this helpful in understanding the market more clearly, share this video with a friend, a family member, or anyone trying to make more thoughtful financial decisions. And if you want to continue following how smart money thinks and acts, subscribe to the Secure Path Finance channel. We don't promise quick riches. We focus on understanding the system, managing risk, and playing the long game. Thank you for your time today. I'll see you in the next video.